Now, on today's top three things, and again, I try to boil down the top three things that are moving macro markets. And again, this is a dynamic and nonlinear world where these things change. But again, I try to focus the mind on those top three things. So let's just do that. Today's top three things in my notebook are number one, the US dollar, number two, oil, and number three, all of Europe. So let's just first get into the US dollar. It's an interesting but maybe not surprising setup if you look at what happened yesterday. Number one, retail sales slowed 0.8% after slowing, by the way, in the month prior. So again, you did not get these huge retail sales numbers associated with the down gas price thesis. By the way, if you went to fill up your car, you didn't go fill it up twice. So that is reported nominally as lower retail sales. So again, that was point number one. Point number two is jobless claims shot over 304. And point number three, the dollar went down. So again, what happened yesterday was largely driven by a down dollar move. The best performing sectors in the S&P 500 on the day were, of course, highly correlated to the inverse of that, which is down dollars. So again, you had up energy stocks, up basic material stocks, and again, actually the consumer discretionary stocks underperformed on the day. Now that's point number one. That's not a trend, that's a counter trend move. So again, you have to trade around that, you have to accept it. It is what it is, it's driving markets big time. Now point number two is oil. If you look at what's happened in oil, it was up 5% on that. So again, a down almost 1% move in the US dollar index equated to an almost up 5% move in oil. So again, the correlation beta is what we call it to that is extremely high. So again, watch out for that. And you have to ask yourself at this point, with the price of oil in particular, is the up 1% fall through today the new trend, or is the down 33% that it's been down in the last 3 months the trend? So again, we have to contextualize that with what we call the immediate term risk range, which is not the trend. The trend is intermediate term, which is called 3 months or more. But on the immediate term risk range, what's interesting about oil at this point is that the range is narrowing. So that says really three big things. Number one, a narrowing range leads to lower volatility. So if you look at something like OVX or the oil volatility index, that looks like it may have put in a short-term top. The second point is that we're getting lower highs in oil in the risk range. And the third point, we're also getting, we're getting higher lows in oil and we're getting lower highs. So again, lower highs is bad and higher lows is good. And declining volatility is net not horrible. So again, that makes for a very confusing setup. And again, if the dollar holds and bases again, oil's going to go down. So again, hold yourself within the risk range is what I'd say about that. Trade the risk range, manage the risk range, use the risk range to trade equities that are associated with that, which is again, dollar versus oil. And the current risk range that I have in my notebook for the price of oil, and again, I'm looking at WTI, is 47.42 to 53.45. Now, the third big thing that's going on this morning is, of course, Europe. Europe has been saved, naturally, of course, always. They needed $1 trillion to do what? I mean, German economic data accelerated in the fourth quarter, evidently. So mainstream media is going to run with that. That was the only good data point out of Europe this morning, so they'll focus 100% on that. It was a very good data point. We've said it a whole bunch of times. I'll say it again. If you had to be long and short things in Europe, you'd be long the good balance sheets and the only economy, really, that has the best economic data, which is Germany, and you'd be short the crap. And I said this on Fox the other day. It's fine for me to say it here. They're definitely not going to fire me here. But the reality is that that's what I said, and I'd say it again. So again, if you look at the economic data away from Germany, again, a 1.6% year-over-year GDP number, it's not great. It's just not terrible. If you look at the rest, I mean, Italy had a negative GDP number. France had a flat year-over-year number. If you start to look at the January numbers, because again, these are European data points for the fourth quarter that I just addressed, the current data points, the January numbers on deflation, which is different than growth. When you think about macro, again, if you want to do it right, think about growth and inflation and try to remain sober at the same time. These things bounce around. They're not the same thing. On the deflation reports this morning, you had very deflationary numbers for the month of January. You had Swiss PPI drop 2.7% year over year. PPI is producer prices. And then, of course, you had Spanish CPI, which is consumer prices, that went negative year over year on the order of 1.3%. So they have deflation. That has not changed. Arresting the deflation has been next to impossible. I do not think that Draghi will be able to do that on an ongoing basis. And again, there will be a different thing that's called the market in Europe versus the economy. Sound familiar? Remember QE in 2011 in this country? The market ended up going up in certain components. Utilities were up a bunch, financials were down a bunch that year, but the economy was terrible. So again, the economy versus markets. This is a very important thing to delineate when you're trying to delineate things, because again, it's not a linear path between the two, which makes this very difficult. Again, it's not an easy game to play. Anybody who absolutely nailed yesterday's move on, hey, I wanted the retail sales number to be bad and then everything else to go up, I mean, that would have been a nice call to make. But again, these are very difficult calls to make when you think about those top three things altogether.